Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is on lessons learned from the Dow. The Dow Jones Industrial Average had a major shakeup this week, right? One of the biggest ones they've had in 10 years. And what was the reason behind it? Tech. It was all tech related. That was the motivation. That's the lesson that we want to learn from this. Now, last week, we did a segment we called the most important stock split in history. We questioned whether or not Apple's stock split was the most important ever in history, right? A stock split is supposed to be a non-economic event. Whether I have a $5 bill or 5 ones, it should be the same, right? That's what a stock split is. But when it comes to the Dow, it has a major influence. Why is it so important? Well, the Dow, you'll remember, is price weighted. It's not market cap weighted. It's price weighted. That means the stocks with the higher prices get the higher weight. And Apple had received the most weight in the Dow. It was higher than anything else. Following the stock split on the 26th, Apple's going to go from the number one slot, being the most important, to, 14th, 15th, 16th most important one. It's going to decline sharply. Now, in addition to that, what's left? Then what was left in the Dow out of the top 10 was just Microsoft. It was the only tech company left. So the Dow was getting out of sync. It was getting out of sync with society. We're going through this digital revolution, this digital super cycle. You don't want to be underweight tech on a persistent basis with that as the backdrop. That just doesn't make any sense. Now, the Dow, again, it's price weighted. It only has 30 securities. We know we're not supposed to get that excited about it. It has all these flaws, but yet it is the most popular index. It's the most popular index with retail people, and it's still the most popular index with professional investors as well. I can assure you of that. We know we're not supposed to put too much importance on it, but if you ask somebody at the end of the day, how'd the market do? They're going to tell you the Dow was up 200, the Dow was down, whatever. Right? They're most likely their first response is going to be related to the Dow. So that's why this is important. Now, what's the lesson that we can learn from this? Well, just as the membership committee, we have to think about tech on a nonstop basis. And we mentioned this in another video on value. The problem with value is that value is underweight tech. The value basket, as it's defined, is underweight tech. So if you have a value tilt, that makes sense. It's probably still a good idea, but don't underweight tech in the process, not during a tech revolution. That's the part that doesn't make any sense. That's the reason value has been underperforming growth by such a wide margin. Now, also, if you think about you should think about this for all strategies. The one I was going to mention next was the long short portfolios. Right? If you have somebody that's long 20 tech companies, they're all small in size, and they're short Apple, well, that's stupid as well. There's only one Apple. There's only one leader to this digital tech revolution. And right now, that leader is Apple. It is within the tech space, it's tech hardware, right? And Apple is the leader there in the tech hardware space. Some people refer to it as becoming the United States of Apple. That's how important it is. We have to remember this. When we have these super cycles going on, we don't want to get in front of them. We want to jump on that bandwagon and run with it. Okay, so with that, what did the Dow Membership Committee do? Well, they added Salesforce, Amgen, and Honeywell, right? So remember, there's only 30. They added 3 new ones, which is quite a bit. They added these 3. They kicked out Exxon, Pfizer, and Raytheon. Okay, so let's talk about that for a second. They added Salesforce.com, obviously a direct tech play, right? That is going to improve the tech weighting in the Dow, right? That one's very clear. Amgen, what about Amgen? That's biotech. Again, tech related. It's another field of tech, but it's still tech related. You need that as part of the index. Now, what about Honeywell? Honeywell, Well, Honeywell's an industrial. It's not a tech firm. It's an industrial. But they introduced cyclicality. They made the index more cyclical by bringing Honeywell back into the Dow Jones Industrial Average. I say bringing it back. Remember, up until 2008, Honeywell had been in the Dow for a long time. And then after years of poor performance, weak earnings, they were removed in 2008. And now they're being placed back there again. All right, just as interesting as what they added, though, is what the Dow removed. The big one I want to focus on is Exxon. This is huge, actually. This is huge. Exxon has been in the Dow Jones Industrial Average since 1929, since the Great Depression, right? Remember, Exxon was previously Standard Oil. We're talking John D. Rockefeller. This is history books. Wrap yourself in the flag time, right? This has a lot of memory to it. So by removing it, that's a big step. But it's really the second big step. Because you remember, the Dow Jones Industrial Average started in the 1880s. And the only company that had been in since the very start was General Electric. In 2018, they took GE out of the Dow. All right, that was the big step. That was the huge step, right? Taking out the lone survivor, the last one, they removed it. So Exxon, was a second step. It's a little bit easier, but from a historical standpoint, it's no less significant. Now, think about that as well. We've talked about this several times. You're removing an energy company. That is also part of a structural shift. I've said many times, energy for the next 10, 12, 15 years, to me, is only a tactical play. It's no longer strategic. This green movement, right? The greener philosophies, the greener attitudes are taking over. They're not going away. We're just going to become more and more energy efficient going forward. And so with that in mind, it makes sense to remove an energy company from the Dow Jones Industrial Average and make it more reflective of, going forward, of things going forward. Okay. So that's our message for today. Hey, if you enjoyed this video, help a fat guy out if you would, all right? Please subscribe to my YouTube channel. It's called Rich Insights. Or on LinkedIn every day, we have a series of posts. We call them Fat Stackonomics. I think you'll enjoy those as well. So take a look at those. All right, I'm Don Rich, and you just experienced a Rich Insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.